Welcome to the Level 1 Equity Summary video series. This video is a summary of the reading on market efficiency. Market efficiency concerns the extent to which market prices incorporate available information. Investors are interested in market efficiency because if prices do not fully incorporate information, then opportunities exist to make abnormal profits. From a testability perspective, you need to know that the following is true in efficient markets. Asset prices reflect new information quickly and rationally. What does quick mean? Quick is relative to the time a trader takes to execute an order. So if a trader executes an order in 1 minute, then quick would mean less than 1 minute. If in a given environment it takes 5 hours to execute, then quick would mean less than 5 hours. Prices should only react to unexpected information. The point is that in efficient markets, all existing information is already contained in the price. So if the price changes, it should only be due to unexpected information. In efficient markets, market price is equal to intrinsic value. Intrinsic value is the value that you calculate based on the fundamentals, the value based on expected cash flows and risk characteristics. So if everybody has that information, all investors have that information, then the price in the market at which you can actually buy and sell should be equal to intrinsic value. And if that is the case, then a passive investment strategy is preferred over active. In an active strategy, you are trying to buy underpriced. But what we are saying here is that if the market is efficient, then there will be no underpriced securities. So it makes more sense to create a portfolio based on an index. So just focus on the appropriate level of diversification and don't worry about trying to buy underpriced securities, because in an efficient market you will not have any underpriced securities. What are the factors which contribute to market efficiency? The big one is market participation. So if there are lots of market participants, then the market will be more efficient. Information availability and financial disclosure. If there is a high amount of information and high amount of disclosure, that makes markets more efficient. Limits to trading. If the limits to trading are low, that makes the market more efficient. A classic question is related to short selling. If there is a restriction on short selling, that makes the market less efficient. Efficient should be viewed as efficient within the bounds of transaction costs. Also consider information acquisition costs. So these are two larger points. Let's say that a stock is currently selling for 20. You believe that the intrinsic value is 20.5 and the transaction cost is $1. Then would you buy this? You would not buy it, because after spending $1, your investment is 21. So if you believe that the true market price should be 20.5, that doesn't help you given that you are spending 21. So the point is that when we talk about efficient markets, we should also consider the transaction costs. And also it might cost us money to figure things out. That money is called information acquisition cost, and that should also be considered. Just a quick terminology alert. In the curriculum, they often use this phrase, with respect to efficient markets. When they say something like this, this means that you should assume that markets are efficient. What are the different forms of market efficiency? You can have weak form, semi-strong form, and strong form. In weak form efficient markets, all past market data, so this is volume data, this is price data, we assume that all this data is built into security price. Public information other than stock market data is not necessarily incorporated. Private information is not incorporated. So if a market is weak form efficient, technical analysis will not lead to abnormal profits, because all the input for technical analysis is already built into the prices. But can fundamental analysis, good fundamental analysis, lead to abnormal returns? The answer is yes. Tests of whether security markets are weak form efficient involve looking at patterns of prices and determining whether trading rules can be used to make abnormal profits. So if you are studying a particular market and you realize that there are certain trends and patterns, and you can follow those trends and patterns and make an abnormal profit, then is the market weak form efficient? The answer is then it is not weak form. Semi-strong builds on top of weak form. So semi-strong form says that the market is weak form, and in addition, public information is built into the stock. However, private information is not built in. Efforts to analyze publicly available information are futile. The point is that if publicly available information is already built into the stock price, then trying to buy or sell based on public information is futile. So fundamental analysis will not help make abnormal returns. Will technical analysis help make abnormal returns? No. The reason is semi-strong already covers weak form. Researchers test for whether markets are semi-strong efficient using event studies. Most research indicates that developed securities markets are semi-strong efficient. And finally, we come to strong form, which says that if markets are strong form efficient, then all information, public and private, is built into the stocks. Most research indicates that markets are not strong form efficient. Researchers test whether a market is strong form efficient by testing whether investors can earn abnormal profits by trading on non-public information. Next, we come to pricing anomalies. The point here is that if it appears that intrinsic value is different from market value, then there might be an anomaly. Although considerable evidence suggests that markets are efficient, researchers also reported several potential inefficiencies or anomalies. Now, on this, I'll give you the most testable point. According to the curriculum, many anomalies might simply be a result of data mining or snooping. So the anomalies are not real. The anomalies are there because of the mechanism that was used to identify those anomalies. If an anomaly were well known, then what would every trader try to do? They would try to exploit that anomaly and it would go away very fast. On this slide, I am listing some of the anomalies and the categories. At the very least, you need to be aware of these terms. And if you want to be more diligent, then in the regular lecture or from the curriculum, you can read a couple of lines related to each of these. Behavioral finance uses human psychology to explain investment decisions. Now, I'm not going to go over these terms. Here again, I want you to at least know the terms, and if you want to be diligent, then in the curriculum or in our regular lectures, you can see a couple of lines on each of these items. This might show up on your exam, but I know that this material is emphasized in later levels, so I think the probability of being tested on this at level 1 is relatively low. It's much more likely that you will see this at later levels. But again, to be safe, you should know a couple of lines about each of these items. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.